Today, I'd like to go over the housing situation that we're currently under. I want to highlight, first off, starting with an article that came by my desk. The article basically says that houses are overpriced. Well, as you recall, about 2 months ago, Jerome Powell, the chairman of the Federal Reserve, said that the housing market was unhinged from fundamentals, was his quote. Well, yes, it was unhinged from fundamentals, but at the time, you weren't seeing a lot of articles from analysts saying that the prices were overbought or too high. So you have a situation here where now we're starting to see analysts actually bringing up the word crash in their articles. So I found this article out there, and this article basically says that we've got 11 states that are particularly vulnerable to high prices and the potential of a crash. And what's interesting about it is when it lists these states, I've highlighted them in yellow and green. The yellow is the Intermountain West, the Rocky Mountains, Idaho down through Arizona and Nevada. And then you have on the East Coast with the North Carolina, South Carolina, Georgia, Tennessee, then Georgia, Florida, on down that direction. So we've got those states, and then we've got a couple of miscellaneous states, Hawaii, number one, and then Washington State is also an overbought situation. Just a story in Washington, I know people in Washington, and they were making offers on as many as 30 different houses and not getting them because they were being outbid by other people. They bought houses at as much as $60,000 over the asking price in the Seattle metro area. So I can understand how Washington might have had that situation. But what's happening now, though, is quite the reversal, because when Jerome Powell said that it was unhinged from fundamentals, one of the things that increasing interest rates does is it cools the housing market. Well, how cool? How bad is the cooling off of the housing market? So the first one I want to go over is existing home sales. In other words, you've already lived in your home and you're now selling it to move on to another home, smaller, larger, whatever. And existing home sales in January peaked at 6,490. The challenge here is that it's gone from a high of 6,490 down to now in May at 5,410. So sales are starting to slow actually pretty dramatically, because that's 1/6 of the total that it was in January, and it's already down that far. So if it's going to cool off that fast, that's about a 17% cooling. If it's going to cool off that fast in existing home sales, you know that there's going to be sellers out there that want to get their house sold, and they're not going to get the premiums that they were getting 6 months ago. And because they're not going to get those premiums, what results in that is, if it keeps slowing down like this, they're going to potentially lower their prices. The next one is housing starts. And here, this one looks like it dropped off the cliff, going from 1810 here down to 1549. So, that's a 15% drop right there again. And so existing housing starts, in other words, builders are becoming more and more reluctant to build spec homes that are not pre-sold. So housing starts are going down because they're not confident that they can sell it right away, and they have to make sure that they have enough money to keep the homes until they sell and build other homes and keep people employed. So it's a situation where they're going to slow down when they lose confidence as well. So that's what we're seeing. Now, the one to buck the trend, which is kind of interesting, is this next one, the new home sales. Now, home starts are slowing down, but new home sales sped up this last month from 629 to 696. So this kind of illustrates the fact that it's simply a bunch of homes that were in stock and trying to be sold that have been pushed through to buyers, maybe in this last minute rush to get them out. I would not expect that number to continue going up. I would expect that number to float back down to the 629 level or lower when we look at June's data. So as we start looking at the cause, the reason why housing is slowing down, we can look at the fact that inventory of houses for sale is starting to creep up. Now, before the COVID recession, housing, fluctuated in cycles, up and down. And then, of course, when COVID came, you couldn't show houses, and people didn't want to list houses because they didn't want people traipsing through the houses and bringing COVID in and then them getting sick and so forth. So the whole housing market just dropped down. But what happened then was, as people started buying, the inventory kept dropping and dropping and dropping, as housing couldn't be built because the supply chain for lumber was corrupted and couldn't get enough lumber, and all the permits that would have been approved for new homes waned through this period of time through COVID with all the lockdowns and such. Builders couldn't get out and actually build. So the inventory, because people were probably buying or wanting to buy just as much during this post-recession period, and the supply just continued to go on down. Now, it had a rise there toward the end of or middle of June 2021. Actually, toward the end of 2021. This is the middle of 2021 there. So during this whole period during the summer, it's rising and then dipped down again. Now, we see in January where the houses had a robust amount of sales, that the inventory had dropped. But now the inventory is starting to peak up as people are not buying as many houses. But about as many houses are being put on the market. So we're seeing an increase in inventory. Well, an increase in inventory means that people can't get the premiums that they did when there was scarcity. It's a regular supply and demand curve, just like any other retail business. So the less supply that you have out there, the higher the price. And conversely, as this supply continues to rise, the price will begin to slow in its increases and eventually will tip downward as time goes on. So the last one I want to show you here is part of the reason why all this is happening. Look at what mortgage rates have done. Mortgage rates now are higher than they were before COVID. And so we see this peak here at an average 30-year mortgage of 5.7. We see in the middle of COVID that it was at 6.52. So it's not quite as high as it was back then. But you see that it's not this abnormally low amount that it was post-COVID, when people were starting to buy up houses like crazy. And a lot of this very, very low interest was the reason why the supply went down so fast. The sales price was screaming forward very, very high. So what you have is a situation where the market is cooling. It's cooling by design, according to the Federal Reserve. It will continue to cool off. The big question is, we're hearing the word crash more and more in the analysts' mouths. And I'm beginning to think that maybe there's a crash pending. Now, it's not going to be as bad as 2008, when the market just tumbled because it was way oversold because of these no-doc mortgages. In other words, all you had to do is say, hey, I earn this much money. Okay, good, you get a loan. Now, it's tightened up. Their mortgage rules for giving loans is tightened up a lot. And so we don't have that situation where all of a sudden the mortgage market totally seizes up and people can't get mortgages, where just the day before they were getting mortgages without any documentation on income or debt, and literally were buying up houses like crazy. So you have a situation where you had a perfect storm in 2008. Now, not so much. You won't see the kind of crash in 2008, but you are going to see definitely a decrease in the pricing of houses as we go forward. So if you've enjoyed what you heard here, please help me grow the channel by subscribing down below, and I hope to see you again. Thanks.